Hi everyone, so in this video I'll be sharing more about the reflexivity theory, which is popularized by George Soros. So if you didn't know, George Soros actually made one of the largest profits in currency trading when he shorted the British pound back in 1991 and made billions of dollars. So what is George Soros' theory of reflexivity, and how can we use this knowledge to help us understand the markets? So reflexivity theory in economics basically says that there's a feedback loop in which investors' sentiments and perception can drive the fundamentals of the company. This will in turn drive the stock price up or down and then affect investor sentiments and perception once again. And this will be like a cycle that keeps on repeating. So an example of this we can see today is how Tesla stock prices have been shooting through the roof. So what is actually happening is that there are a lot of people and participants in the market, and all of them have subjective perception or subjective reality, and when they use this subjective reality to make a decision whether to buy the stocks or not, it will actually influence the objective reality. So in this case, a lot of people think that Tesla is good and Tesla stock will go up. Elon Musk said that Tesla will do a 5 billion capital raise, and this announcement, coupled with investors' strong and positive sentiment about Tesla stock, has driven the share price up drastically. The stock price of Tesla jumped 10x just from 1 year ago. Another example of reflexivity theory in play would be the GameStop saga that happened earlier this year. So it shows us how a hype is self-sustaining when investors, or maybe you wouldn't even call them investors, right? More like participants in the market, when they make their decision to buy the stock based on their subjective reality, and their collection of thoughts affects the fundamentals of the stock and thus affects the price, and therefore affecting the perception once again in a huge cycle. So to sum up, the theory of reflexivity by George Soros teaches us that the outcome can affect the process. And concepts like economic equilibrium, or EMH, the efficient market hypothesis, isn't valid in real life and is essentially counter to the theory of reflexivity. That's all I have for this video, and do remember to like and subscribe to my channel for more videos on mental models, investing, and book reviews. Take care, and I'll see you in the next one.